So we are done abandonment in the last class. So I gave you an assignment, your attempt on the abandonment. So what we do now, we go to the replacement analysis. Let us now go to the replacement analysis and see. We were on the real options. We were discussing the real options. So one of the real option was basically abandonment in capital budgeting. And we had discussed what we mean by the abandonment. So today we want to look at the replacement. When it comes to replacement, what normally happens is that you simply undertake a project for some time, then you actually do away with it. So let us write something brief about replacement decisions. So our real options, there were two. The first one was abandonment. The second one is now replacement analysis. So we are now discussing replacement analysis. We are now discussing replacement analysis. So we can write that. We can write that it involves replacing old and inefficient assets. It involves replacing the old and inefficient assets, replacing the old and the inefficient assets with new and more efficient assets, with the new and more efficient assets, with the new and the more efficient asset, new and more efficient asset, new and more efficient asset, which is more economical to operate, which is more economical to operate, which is more economical to operate. Then another paragraph, we write that under replacement analysis, comma, the company will be concerned with, under the replacement analysis, comma, the company will be concerned with, it will be concerned with the incremental cash inflows, it will be concerned with the incremental cash inflows and incremental cash outflows. Will be concerned with the incremental cash inflows and incremental cash outflows and the incremental cash outflows. Then another paragraph is that for the replacement analysis to be carried out, for the replacement analysis to be carried out, for the replacement analysis to be carried out, comma, the remaining economic life, the remaining economic life of the old asset, the remaining economic life of the old asset must be equal to the economic life of the new asset, must be equal to the economic life of the new asset, must be equal to the economic life of the new asset. In order to make it possible, to compare, the incremental benefits and incremental costs. Make it possible to compare the incremental benefits and incremental costs. Incremental benefits and incremental costs of the two assets. Then another paragraph, we note that under the capital budgeting framework, under the capital budgeting framework, comma, replacement analysis is carried out. replacement analysis is carried out. The replacement analysis is carried out by adopting the following 6 steps. Under the capital budgeting framework, replacement analysis is carried out by adopting the following 6 steps. By adopting the following 6 steps. So we start off with the step number 1. So step 1 is that determine the incremental cash outflow associated with the replacement as follows. Determine the incremental cash outflow associated with the replacement as follows. Determine the incremental cash outflow associated with the replacement as follows. Associated with the replacement as follows. So this is now how you will be coming up with the incremental cash outflows. This is now how to come up with incremental cash outflows. Incremental cash outflows. So if you want to calculate incremental cash outflows, the incremental cash outflows, we start with the initial cost. Initial cost of the new asset. The initial cost of the new asset. Initial cost of the new asset. Then we add installation cost. Installation cost of the new asset. Installation cost of the new asset. So that you get the total initial cost. The total initial cost. Get the total initial cost of the new asset. Total initial cost of the new asset. Then you will be required to add changes in working capital. If you add the changes in the working capital, you will also be required to add. You should also be required to add overhaul cost. Overhaul cost. At that point, overhaul cost. Then you will be required to less market value. Market value of the old assets. The market value of the old assets, so that you get the gross cash outflow, get the gross cash outflows, get the gross cash outflows. Then you are supposed to add tax on the capital gain, tax on the capital gain. So to get the tax on the capital gain, you start with market value of the old asset. Market value of the old assets. You start with the market value for the old assets. Then you less net book value. you less net book value of the old assets, net book value of the old assets. So the difference is supposed to give you capital gain or capital loss. The difference is supposed to give you the capital gain or loss. So if you get the capital gain, if you happen to get, because we don't normally tax a loss. So in case you get the capital gain, multiply it by the tax rate. Multiply it by the tax rate, then you get the value like that. So this capital gain, I'm saying only if it is what? Capital gain multiplied by the tax rate. You get now tax on the capital gain. So now you add it on that to get the incremental cash outflows. Get the incremental cash outflows. So that's how you will come up with the incremental cash outflow. Remember, tax on the capital gain, you take market value for the old asset, you less net book value of the old asset. So it can either be a gain or a loss. We don't normally tax a loss. So only get it as a gain. So once you get a gain multiplied by the tax rate, the figure you get, you put it there. So you add this figure on that to get the incremental cash outflow. If it is a loss, you ignore. If it is a capital loss, we ignore because we don't tax losses. That now will be the step number one. That will be the step number one when you want to get the incremental cash outflow under the replacement analysis. We now go to the step number two. We go to the step number two. We now go to the step number two. So step two is that determine the incremental depreciation per annum. Determine the incremental depreciation per annum. We determine the incremental depreciation per annum. So this is how to calculate the incremental depreciation per annum. This is now how to calculate the incremental depreciation per annum as our step number two. So incremental depreciation per annum, incremental depreciation per annum. So to get incremental depreciation per annum, start with depreciation per annum of the new asset. Depreciation per annum of the new asset. Depreciation per annum of the new asset. Then we less depreciation per annum of the old assets. We minus depreciation per annum of the old asset. So once you have done that, what you will get there is now incremental depreciation per annum. So to get the incremental depreciation per annum, you simply take depreciation per annum of the new asset with less depreciation per annum of the old asset. That's now our step number two. Step number three, we will be that determine incremental salvage value. The step number 3 will be that determine the incremental salvage value. Determine the incremental salvage value. So the step number 3. Step number 3. So someone is using the iPhone, kindly use your name. When you are using the iPhone, kindly use your name, because we don't know whom you are. Chances are I will put you in the waiting room because we don't know whom we are dealing with. Can you use your name, someone using the iPhone? Yeah, I will either put you in the waiting room or I remove you in the class group. Okay, so when you join the class, kindly make sure that we are aware of the people we are dealing with. We only deal with our students. If you don't use your name, we don't know whether you are our student. So make sure that you join the class using your names. So we go to the step number 3. Step number 3 is that determine the incremental salvage value. The step number 3 is that determine the incremental salvage value. So to get the incremental salvage value, So incremental salvage value. Incremental salvage value. Incremental salvage value. We start with salvage value of the new asset. Salvage value of the new asset. Then we less salvage value of the old asset. Less the salvage value of the old asset. So that now you get the incremental salvage value. So when you want to get the incremental salvage value, simply start with salvage value of the new asset. We subtract the salvage value of the old asset. Now we got the step number 4. So step number 4 will simply be that determine the incremental annual cash inflows. 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 So let us now see how to calculate the incremental annual cash inflows. I want to see how to get the incremental annual cash inflows. Incremental annual cash inflows. So to calculate the incremental annual cash inflows, it is like preparing the cash flow statement. It is like preparing the cash flow statement. There are two formats. We can use the cash flow statement, or we use the formula we had been applying in order to get the annual cash inflows. So we start the incremental sales revenue. We start the incremental sales revenue. Start off with the incremental sales revenue. Then we less incremental variable cost. We less the incremental variable cost. We also less incremental fixed costs. We also less incremental fixed costs, so that we end up getting incremental. We get the incremental earning before depreciation and the tax, so that we get the incremental earnings before depreciation and the tax. We get the incremental earnings before depreciation and the tax. Then after that, we less incremental depreciation. We minus incremental depreciation per annum. We minus incremental depreciation per annum, so that we also get incremental earnings before the tax. Incremental earnings before the tax, so that we get the incremental earnings before the tax. Then now we also less the tax. We minus the tax. We minus the tax, so that you get the incremental earnings after the tax. Incremental earnings after the tax. Incremental earnings after the tax. Then remember, depreciation is not an actual outflow of cash. So we add back a depreciation. We add back the depreciation. So incremental depreciation. We add back the incremental depreciation per annum. We add back the incremental depreciation per annum, so that now we end up having the incremental annual cash inflows. So that we get now the incremental annual cash inflows. So that we get the incremental annual cash inflows. So that is a normal cash flow statement. That is a normal cash flow statement. Or alternatively, you remember we can use the other formula, whereby annual cash inflows, annual cash inflows, also annual cash inflows, it is supposed to be given by earnings before depreciation and the tax, 1 minus the tax rate, then you add depreciation multiplied by the tax rate. You all remember this formula, you have been using it sometimes. So also to get our annual cash inflows, we simply take earnings before depreciation and the tax. 1 minus the tax rate. Then we add depreciation multiplied by the tax rate. That should be now our step number 4. That will be our step number 4. We got the step number 5. There is also the step number 5. So step number 5 will be that determine the incremental terminal benefit. The step number 5 will be that determine the incremental terminal benefits. 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 So this is now how to calculate incremental terminal benefits. This is now how to get the incremental terminal benefits. How to get the incremental terminal benefit. So to get the incremental terminal benefit, you start with the incremental salvage value. Incremental salvage. Incremental salvage value. We add changes in the working capital. You add the changes in the working capital, so that now you come up with the incremental terminal benefit. So that you come up with the incremental terminal benefit. So finally, the step number 6. The last step, number 6, will now be evaluate the project. Step number 6 is that evaluate the project using the appropriate evaluation technique. Evaluate the project using the appropriate evaluation technique. Evaluate the project using the appropriate evaluation technique, i.e. NPV, or profitability index, or IRR. So you can just pick any, but most of the time NPV. But sometimes the question will specify which method to use. So that's now a summary on how we shall be carrying out replacement analysis. So the first question I want us to deal with, the first question I would like us now to deal with, the first question I want us now to deal with, there is a question so I want to start with a smaller question. So let us start with the one for December 2021. December 2021, question number 5, part A. The one for the real exam. December 2021 are 2 papers. There is one for the pilot paper and the one for the exam. So we only pick the one for the exam, December 2021. December 2021, question number 5, part A. December 2021, question number 5, part A. Remember, there are 2 December 2021, the one for the pilot paper and for the exam. So we shall not be checking the one for the pilot paper. We check the one for the exam. So there is a question number 5, part A. I want us to start with that question, being the latest on that part of the topic. So that question reads that Bobo Limited is contemplating. You have identified the question? So Bob Limited is contemplating replacing an existing machine. Is contemplating replacing an existing machine which was purchased 5 years ago, at a cost of 825,000. At a cost of 825,000, the machine was expected to have a useful life of 10 years and an estimated salvage value of 40,000 at the end of the 10th year. However, if replaced, existing machine can be sold in the market today at 300,000 shillings. The new machine will have an initial cost of 1.2 million and will have a useful life of 5 years. As a result of increased efficiency that will rise due to replacement of the existing machine, the firm will save 168,000 per annum in the production costs through the new machine's life. In addition, there will be annual savings in the reduction of the wastage estimated at 80,000. Salvage value of the new machine is estimated at 100,000 at the end of its useful life. Then additional information, the firm will provide for depreciation on the straight line basis. It will provide for depreciation on the straight line basis. Then also, cost of capital is 14%. Also, the cost of capital is meant to be 14%. The corporate tax rate applicable is 30%. The corporate tax rate applicable is 13%. Now required Roman letter 1, using net present value approach. Advise the firm on the replacement decision. Also state any 2 assumptions you made in your calculation in A, Roman letter 1 above. So I will be taking you through the steps we have followed, but not all of them will be the way I have presented, because some of the items are not in the question. Some of the items are not there in the question. So I will only be picking the ones which are there. Then from there, we see how to solve the question. So we start with the step number 1. We start off with the step number 1. So step 1, when it comes to the step number 1. So we start with the step 1. So step 1, we simply get the incremental cash outflow. Our first step will be to come up with the incremental cash outflow. Our first step is to calculate the incremental cash outflow. So to get the incremental cash outflow, when you check in the format I've given you, we start with the initial cost of the new machine. We add installation cost of the new machine. We get the total initial cost. Then after that, you are supposed to add changes in the working capital, you add overhaul cost, you less market value of the old asset, then you are supposed to add the tax on the capital gain. But all those items may not be there. So I'm only picking the ones which are in the question. I'm only picking the ones which are in the question. Among those in the question, you go to the step number, you go to the paragraph number 2. You can see in your paragraph 2, they have said that your machine will have an initial cost of how much? 1.2. So it has no installation. You see that? So I'm only picking the items which are in the question. So we start with the initial cost of the new asset. Initial cost of the new asset. Start with the initial cost of the new asset. So that initial cost of the new asset, it is simply 1.2 million. It is simply 1.2 millions, like that. It is simply 1.2 million. So in the format, you are supposed to add the installation cost, but the question has not given us. Then you are also supposed to add changes in the working capital. The question did not give us anything to do with the changes in the working capital. The question also has not given you overall costs. We ignore items that are not given. So what we do, we less market value of the old asset. We are only picking the items that are in the question, but then once we do that, so it was given in the end of the first paragraph. You can see at the end of the first paragraph, however, if request, the existing machine can be sold in the market today at how much? So it is 300. So I would like you to subtract it to get the gross cash outflow. To get the gross cash outflow. Get the gross cash outflow. So what should be our gross cash outflow? So it is giving us 900,000. Then I said we add tax on the capital gain. We are supposed to add the tax. We add tax on the capital gain. So to get the tax on the capital gain, we start with market value of the old asset. Market value for the old asset, we have seen it is how much? 300. So we need to minus the net book value of the old asset from that figure. We need to less net book value of the old asset. We need to less net book value of the old asset. So to get the net book value of the old asset, I want you to check in the first paragraph. In the first paragraph, they had said that that existing machine was purchased how many years ago? 5 years ago at a cost of how much? 825. The machine was expected to have a useful life of how many years? 10 years and an estimated salvage value of how much? So we minus depreciation for the last 5 years because it was purchased 5 years ago. So to get that net book value, you can see the initial cost was 800 and what? So we get 825. We subtract depreciation for the 5 years. So to get depreciation for the 5 years, you say it is on the straight line basis. 825, you subtract the salvage value. The salvage value was given as how much? It was 40,000, but it was supposed to be there for 10 years, isn't it? So this will give us depreciation per year, but it has been there for how many years? So multiply by 5 years so that you get the depreciation for the 5 years. Then you subtract it from the 825 so that we get the net book value after 5 years. So that we get the net book value after 5 years. Get the net book value after the 5 years. Get the net book value after the 5 years. It's giving you around how much? Sorry? 432.5. So it means we have the capital loss. We have the capital loss. How much is that capital loss? So we don't normally tax loss. So if it was a gain, you are to multiply by the tax rate. Then the figure we have. So this one is just a 0 because it is out a loss. So that our incremental cash outflow, will just remain 900 like that. So if it was a gain, you multiply by the tax rate to get the tax on the capital gain, then you would add. But this one is a capital loss. So that is now our step number 1. How to calculate the incremental cash outflow. That is now our step number 1 in that question on how to get the incremental cash outflow. Let us now go to the step number 2. Step 2, if you check through your notes, it is incremental depreciation per annum. Let us now also compute the incremental depreciation per annum. We also calculate the incremental depreciation per annum. So to get the incremental depreciation per annum, to get the incremental depreciation per annum, to get the incremental depreciation per annum, we start with depreciation of the new asset, depreciation per annum of the new asset, So depreciation per annum of the new asset, you simply take the initial cost of the new asset, which is 1.2 millions. 1.2 millions, you minus the salvage value. You can see the salvage value of the new asset in the before additional information. They have said that salvage value of the new machine is estimated at how much? 100,000, which is the same as 0.1 millions. Divide by the economic life of the new asset. Economic life for the new asset is how many years? It's 5 years. So that now will be able to give us what is supposed to be the depreciation per annum for the new asset. Depreciation per annum for the new asset. So it should be able to give us around which figure? 0.22. That is the same as 420,000. There are 3 zeros at the top. Remember these figures I was calculating, there were 3 zeros at the top. So that is now for the new asset. We less depreciation per annum of the old asset. So all the assets, if you recall what we have done up here, so unakumbuka the net book value today for the all the assets. The one you have, it was 432.5. Yeah, so you take the figure of the 432, start the same as 0.4325 million, isn't it? Yeah. You got 432,000, the net book value. Yeah, so that 432.5 is the same as 0.43. I'm using the format of this one. So I still subtract the salvage value. That salvage value was how much? 40,000. Still. Yeah, so 40,000 is the same as 0.04. So, but now we depreciate for the remaining 5 years. Now we depreciate it for the remaining 5 years. We depreciate it for the remaining 5 years. So that figure is the net book value that we had calculated in the step number 1. So how much would be now that depreciation per annum? Sorry. 0.0. So that is the same as 7.78.5. Yeah, so now we less to get the incremental depreciation per annum. So online, I hope we are together at that point. Those who are online. So someone is already asking, why don't we use initial cost? It will still give you the same figure. It will still give you the same figure. And I have given you the rules. One of the rules in the first paragraph, we have said that for the replacement analysis to be carried out, the remaining economic life of the old asset must be the same as what? Economic life for the new asset. Have you seen that rule in the question? Duncan, you are asking why don't we use the initial cost? Can you see a rule in your notes which says that for the replacement analysis to be carried out, the remaining economic life for the old asset should be the same as the one for the new asset? Have you seen that rule in the notes? Umeiona one of the notes in the notes, but still you will get the same thing. Bado utapata the same. Ama I can show you. See, ilikuwa 800 and what? It was 825. Exactly 825. Minus 0.04. But now divide by 10 years. Compute and see what you will get from that point. It is still giving you the same figure. Is the depreciation the same? Not be the same. Yeah, so Duncan, you follow the rules of the replacement. It will still give you the same figure of depreciation, but it is not always the same. There is a question which will give you re-evaluation. So get to note that. Get to note that when you are doing the replacement, you make sure that the economic life is the same. So are we together at that point? Someone was asking that question. Is it clear at that level? When you ask a question, I expect you to respond. Are you okay now at that point? Is it giving you the same? So make sure that the economic life of the two assets are the same when you are dealing with the analysis. But there are some questions, it will not be the same when they give you re-evaluation. So this incremental will be now how much? 100 and what? 141. 141.5. It will give you 141.5. But make sure you follow the rules of replacement. For the replacement to be carried out, the remaining economic life of the old asset should be the same as the one for the new asset. We go to the working number 3. Working number 3 will be incremental salvage value. The working number 3, we get the incremental salvage value. Incremental salvage value. We now get the incremental salvage value. When it comes to the incremental salvage value, we start with the salvage value of the new asset. Salvage value of the new asset. Remember, it is 100,000. I'm using 3 zeros at the top. You can see the salvage value for the new asset. It is 100,000. You less the salvage value of the old asset. Remember, it is 40,000, 0.04. So the difference will now give you the incremental salvage value. The difference should now give you incremental salvage value, which is supposed to be how much? It will be able to give you 60. So we go to the step number 4. We now go to the step number 4. So step 4, we are supposed to calculate the incremental annual cash inflows. Our step number 4, we come up with incremental annual cash inflows. We now get the incremental annual cash inflows. We should now come up with the incremental annual cash inflows. So incremental annual cash inflows. Incremental annual cash inflows. So in the format, I gave you sales revenue minus variable cost minus fixed cost. You get the earnings before depreciation and tax. You less incremental depreciation. You also less the tax. Then you add back. So this question has no information of that nature. For them, it is only the savings. You can see the savings. Yeah, they did not give us the sales revenue. They have not given you anywhere the sales revenue, but instead they have given us savings. So we use now the savings. We shall be required now to apply the savings. So when you check in that paragraph number 2, they said that as a result of the increased efficiency that will arise due to the replacement of existing machine, the farm will save how much? 168. So that is now our cash. So we start with the savings. The savings, so that saving is in the production costs. So savings in the production costs. So we have the savings in the production costs. We have savings in the production cost, and that figure is 100 and what? So there are 3 zeros at the top, so I'm just simply using 168. Then apart from that figure, you are also given another savings. You can see another saving. There will be annual savings in the reduction of wastage, estimated at how much? 80. We also add savings. We also add the savings on the wastage. Savings on the wastage, which the question had given you 80. So add them together so that we get the savings before depreciation and the tax. So that we get the savings before depreciation and the tax. So that we get the savings before depreciation and the tax. How much is that savings? Sorry? 248. Then we less the incremental depreciation. We minus incremental depreciation. We calculated in the working number 2, step number 2. How much was our incremental depreciation? 100.5. So that we get the savings before the tax. We get the savings before the tax. We get the savings before the tax. What is that savings before the tax? 106.5. Then we less now the tax. We less the tax. We minus the tax. So the tax rate was given as what percent? So get 30% of 106.5. We get 30% of 106.5. Sorry? 21.95. Sorry? 31.9. So that we get the savings after the tax. We get the savings after the tax. We come up with the savings after the tax. So what do we have as our savings after the tax? 74.855. Then now we add back the depreciation. Remember, we say depreciation is not an actual outflow of cash. It is just a provision to reduce the taxable income. So add back the depreciation. We add back the depreciation. Remember that depreciation was 141.5. So that we get now the incremental annual cash inflows. So that we get the incremental annual cash inflows. So that we get the incremental annual cash inflows. So which is supposed to be around which year? 216. So that is now our step number 4. There was also the step number 5. So step 5, we need to get the incremental terminal benefit. The step number 5, you are to come up with the incremental terminal benefit. The step number 5, we get the incremental terminal benefit. So incremental terminal benefit, incremental terminal benefit. Incremental terminal benefit. It is supposed to be given by incremental salvage value. Incremental salvage value. What was there as incremental salvage value in the step number 3? We got 60. Yeah, so it is 60. We are supposed to add changes in the working capital, but this question had no changes in the working capital. We are supposed to add changes in the working capital, but they were not there. So just add 0, so you end up having 60 like this. We end up having 60 at that level. Then from there now we compute the NPV, because the question had said that using the net present value advice. So let us now calculate the NPV. We now calculate the NPV. So NPV is supposed to be given by, so NPV is supposed to be given by, NPV will be present value for the cash inflows. We minus present value for the cash outflows. So to get the NPV, it is simply present value for the cash inflows. We minus the present value for the cash outflows. So present value for the cash inflows, because they are annuities. So the first one will be annuity multiplied by present value interest factor for the annuity. Cost of capital in the note number 2. Cost of capital in the note number 2, it is what percent? So it is 14% for 5 years. It is 14% for the 5 years. So annuity is your step number 3. So step number 4. You can see our annual cash inflow in the step number 4. Your cash step 216.05. So the 216.5. That is now our annuity. It is the same every year for the 5 years. So confirm in the annuity table. Annuity table is the second table. What is there as 14% in year 5? What is there as 14% in year 5? Point. Another 3 then 1. So that should be what we have at that level. Then apart from that, there is also the terminal benefit. There is also the terminal benefits. But the terminal benefit normally occur only once. Terminal benefit will only occur once. So we use the first table. Present value interest factor, 14% in year 5. So we have calculated, we got 60. We got the 60, our terminal benefit. Then check in the first table. What should be 14% in year 5? What should be 14% in year 5? 0.51. So add now these two figures together, you will be coming up with the present value for the cash inflows. Be coming up with the present value for the cash inflows. It's today how much? Sorry? 743 point. 750. 772. Point. 8 letters. Online, what are we getting? Hiyo ulipata ngapi kuanzia hapo? Hii ya juu 742. Yeah, online kiwa wananiambia 772.884. So kuna 4 hapo mbele. So we less present value for the cash outflow. We less present value for the cash outflow. So present value for the cash outflow is what we calculated in the step number 1. You see what we got in the step number 1? Our incremental cash outflow. It was 900. Yeah, so present value for the cash outflow is our step number 1. So minus to get the NPV. So our NPV will be negative 127.106. 116. Yeah, so it is 127.11. So it is just 127,116. Yes. It's 3 decimal places because there were 3 zeros at the top. At the top, there were 3 zeros. Yeah, there were 3 zeros at the top. So like now this one, it is just 772,884. Now in 900,000. So that now when you subtract from here, we can just even remove the zero, the decimal point. You can just, so that the amount is now in full. So the full amount is 772,884 as our present, because there were 3 zeros at the top. Then now, so our NPV is negative. Our NPV is negative 127,116. So the advice will be that existing machine should not be replaced. Existing machine should not be replaced. The existing machine should not be replaced, as it will lead to a negative NPV. The existing machine should not be replaced, as it will lead to a negative NPV, as it will lead to a negative NPV. Then we go to the Roman letter 2 of the question. So Roman letter 2, they say that state any 2 assumption you made. State any 2 assumption you had made. You state any 2 assumption you made in your calculation in A, Roman letter 1 above. In A, Roman letter 1 above. So I want to give you the 2 assumptions we have used. I want to give you the 2 assumptions that we have. Number one is that the remaining economic life of the old asset, the remaining economic life of the old asset is equal to the economic life of the new asset. So the remaining economic life of the old asset is equal to the economic life of the new asset is equal to the economic life of the new asset. Then the second assumption is that to carry out the replacement analysis, we use incremental cash inflows. We use the incremental cash inflows and incremental cash outflows. We use incremental cash inflows and the incremental cash outflows. Incremental cash inflows and the incremental cash outflows. Maybe you can add there the second one is that number 3 is that we assume that the cost of capital will remain constant. We assume that the cost of capital will remain constant. We assume that the cost of capital will remain constant. So that is now in relation to that question. So our next question should be November 2020 question 4 part A. November 2020 question 4 part A. Sorry, just a minute. November 2020 question 4 part A. So we have found the question. So we can go through the question. We can now go through the question. November 2020, question number 4, part A. November 2020. So November 2020, question number 4, part A. So the question reads that Ulanda Limited, sorry, Ulanda Engineering Works Limited is contemplating the purchase of a new machine. They are contemplating purchase of the new machine to replace the existing one. To replace the existing one. So existing machine was purchased 2 years ago. Existing machine was purchased 2 years ago at an installed cost of 500,000. the machine was estimated to have an economic life of 5 years. The machine was estimated to have economic life of 5 years with a salvage value, but a critical analysis of its performance now shows that it is usable for the next how many years? 5 years with a resale value of how much? Yeah, so that now complicates the question Duncan you are asking. So this one, you can see this machine was expected to have initially 5 years, isn't it? But it has been there for how many years? 2 years. So how many years are supposed to be remaining initially? 3. But now the question is saying it is not 3, but how many are remaining? 5, which means the economic life for that machine will be 7 years. So don't always assume, follow the details of what the question has provided. So that is now the information provided after the critical analysis. We always use the remaining economic life of the old asset, which must always be equal to economic life for the new asset. Then they continued to say that the current disposal value of existing machine is 200,000. The new machine will cost 600,000, and it require 50,000 in the installation cost. It require 50,000 in the installation cost. And also, since the machine is not locally available, the company plans to import it and will pay import duty and freight charges of how much? 150 and 100,000 respectively. So the new machine shall require an overhaul at the end of the 3rd year, which is expected to cost 100,000. Overhaul cost is to be so amortization is the same as depreciation on the straight line basis over the remaining useful life of the machine to support the increased business resulting from the purchase of the new machine. Accounts receivable will increase by 250. Inventories and accounts payable will increase by 200 and 300 respectively. That will be the working capital. Working capital is simply current assets minus the current liabilities. So you take the accounts receivable, those are debtors, inventory are also, then you minus the accounts payable. That now will give you the working capital. They proceeded to say that they were at the end of the 5 years, new machine will be sold for 250. That's now the salvage value. Estimated profit before depreciation and tax over the next 5 years. Over the next 5 years period for both machine are given as follows. So existing machine and new machine, they gave us year 1, 2, 3, 4 up to year 5. So additional information, note number 1. The corporate tax rate is 30%. The company will use the straight line method of depreciation. Cost of capital is 13%. Capital gains are tax exempt. We shall establish why they are tax exempt. Probably it is a loss. Then now required. Roman letter 1, they were asking you to get the incremental initial cash outflow. That is the same as the step number 1. Remember our step 1, incremental annual cash outflow. Then Roman letter 2, incremental net operating cash flows associated with the proposed machine replacement. That is the same as our step number 4. Remember step 4? Yeah, so that means there are 2 steps in between. Then finally, should the existing machine be replaced? Justify your answer. So normally we calculate NPV. If NPV will be positive, we shall replace. But if it will be negative, we shall not. So let us start with the Roman letter 1. let us start off with the Roman letter 1, where we get this step number 1. Step 1 will be incremental cash outflow. Our step number 1, we shall now have the incremental cash outflow. We need now to come up with the incremental cash outflow. So to get the incremental cash outflow, for us to come up with the incremental cash outflow. So this is the same as our Roman letter 1 of the question, which is the same as the step number 1 when we are doing the replacement analysis. So I will start with the initial cost of the new asset. We start off with the initial cost. Initial cost of the new asset. Initial cost of the new asset. So they have given us the figure for that. They are able to give you the value. So they say that they are able to say that the new machine will cost how much? 600,000. So it will be able to cost you 600,000. So the figures are not big like the other question, which were in millions. So we add installation costs. This time the question had some installation costs. Are you able to figure out the installation cost? So they say that they are able, it requires 50,000 in the installation cost. So this time around, there is also import and freight charges. Are you able to see some import? Yeah, so the company plans to import it and it will pay import duty. So we also add import duty. We also add import duty. So the import duty is 150,000. 150,000. There is also the other one is the freight charges. Also add the freight charges. We also add the freight charges, which was given as how much? So first you add them together to get the total initial cost. When we depreciate, we shall be depreciating this figure to get the total initial cost of the new asset, total initial cost. We get the total initial cost of the new asset. How much is that total initial cost? So it is giving us 900,000. So we add changes in the working capital. We add changes in the working capital. Working capital is the current assets minus the current liabilities. So can you confirm among the current assets? You can see down there, to support the increased business resulting from the purchase of the new machine, accounts receivable will increase by 250. So it is 250,000 plus. Then inventories will increase by how much? 200. Accounts payable will be how much? 300. So you minus the 300 so that we get the working capital. Working capital, it is the current assets minus the current liabilities. So this will give us which we have 150. So that is now changes in the working capital. So this question also had overhaul costs. It had some overhaul costs. So are you able to see overhaul costs? They said that the new machine will require an overhaul at the end of which year? The third year, which is expected to cost how much? Yeah, so anything that is not incurred in year 0, it should be discounted. Anything that is not incurred in year 0 should be done what? Discounted. So we are supposed to add overhaul costs. We add the overhaul cost. But that overhaul cost, we discount it because it was not incurred in year 0. You can see the figure is 100,000. It is 100,000. So we discount it at the present value interest factor. We discount it at the present value interest factor. Cost of capital in the note number 3. You are given what percent? In the note number 3, the cost of capital is 13%. But we know it was incurred in which year? At the end of year 3. So we use the first table. Check in the first table 13% in year 3. Anything that is not incurred in year 0, we discount it to get the present value. So what is 13% in year 3? 0.6931 like that. So when you multiply by 100,000, it is the same as 69,310. So anything that is not incurred in year 0, if you are told it was incurred in year 1, 2, or 3, make sure that you discount it to get it is present value. Even this working capital, if you are told that all those costs were incurred in year 2, that figure of 150 must be discounted in year 2 to get it is present value. Then, yes. Sorry? Yeah, something. Yeah. You have one note to go on. Under the net present value, when you check under the NPV, no, overall cost. Hapo baada tutafikia depreciation. Apart from that, here to calculate depreciation. So, have you seen the notes on the overhaul costs? The sum overhaul is what cost? There are capital expenditure incurred in order to do it. To improve efficiency, also to increase the economic life, also to do it. Yeah. Then, tukasema overhaul cost is depreciated over the remaining economic life. So, we had already discussed that overhaul cost. So, the next item, we less market value of the whole asset. Market value of the old asset. Less market value of the old asset. So the old asset, you are given some details concerning the old asset, where they say that at the end of the fight, not that one, in the first paragraph, where they say that the current disposal value of existing machine is how much? 200,000. So that is now the market value of the old asset. So it is given as 200,000. So you subtract so that we get the gross cash outflow. So that we come up with the gross cash outflow. So we get the gross cash outflow. So that we get the gross cash outflow. We come up with the gross cash outflow. So how much is that gross cash outflow? 919. Like that. Then we said we are supposed to add tax on the capital gain. But the question had said it was exempted. But I want us to confirm why it was exempted. So you can see that note. They had said something in the note number 4. Capital gains are what? Tax exempt. So for me, once you get that, there is no need to factor it in, isn't it? But because of learning, I want to confirm why. Maybe they said it was tax exempt. Probably it is negative. If it is a capital loss, it is exempt. So we are supposed to add tax on the capital gain. Tax on the capital gain. So normally, to get the tax on the capital gain, we start with market value of the old asset. Market value for the old asset, we know it is how much? It is 200,000. Yeah, this same figure that you have there. So we less the net book value. Net book value of the old asset. So to get the net book value of the old asset, we go to the first paragraph. When you check through the first paragraph, they have said that the existing machine was purchased 2 years ago at an installed cost of how much? Yeah, so we take the 500,000, we subtract depreciation for the 2 years because it was purchased 2 years ago. So to get that depreciation for the 2 years, it is 500,000. So I want you to read the question clearly at that point. So they were saying that the machine was estimated to have an economic life of how many years? 5 years with what? With nil. So at this point, don't include the re-evaluation. You can see somewhere. They have given us, when you continue in the question, they said that but a critical analysis of its performance now shows that it is usable for the next how many years? 5 years with a resale value of how much? Yeah, so to get the net book value today, we use the initial information. But when we shall be calculating depreciation now onwards from today, we now use the new information. So for the old information, it is 500, the salvage value was 0. You see initially. Yeah, salvage value only came in after critical what? Analysis. Critical analysis was done after it has been purchased 2 years ago. So divide by 5 years, because initially it was supposed to be there for 5 years. Then multiply by 2 years to get now the depreciation for the 2 years. Then subtract from the 500,000 and see what should be that net book value after 2 years. So that we get the net book value after the 2 years. So how much is that net book value after the 2 years? So you can see it is a capital what? Loss. I suspect that is why it was exempted because now it is a loss. So we get a capital loss. We get a capital loss. So that loss is 50. Yeah, so we just now ignore that figure because it is a loss. We just ignore it because it is a loss. So now you get this total will just remain 919, 310. Sorry? That is the 200. And you might calculate. You know that. So in 300, you subtract you compare 300. And you may compute, so you need the correct figures. So is it 300? Yeah, but still it will be a capital loss of how much? So remember, when we calculate depreciation for the old assets, the net value. When we should be calculating the incremental depreciation, we use the net book value today, which is 300. So the depreciation will not be the same like the other question for the initial economic life. So that should be our Roman letter 1 of the question, which is the same as the step number 1. The step number 1 on that particular element. So now we got the step number 2. That is meant to be the step number 1. So now we got the step number 2. So that step 1 is the Roman letter 1 of the question. That step number 1 is the Roman letter 1 of the question. So in the step number 2, we calculate incremental depreciation per annum. We now compute incremental depreciation per annum. We now get the incremental depreciation per annum. We now come up with the incremental depreciation per annum. So incremental depreciation per annum, incremental depreciation per annum. Get the incremental depreciation per annum. Incremental depreciation per annum. So there are 2 items to be depreciated. There is overhaul and the initial cost. Overhaul, so we need to separate them. So the depreciation for year 1 up to year 3 will be different. I'm separating them because of the overhaul. Then there will be another one year 4 up to year 5. I'm separating them because of overhaul. So we start with the one for the new asset. We start with the one for the new asset. So new asset has 2 items. The new asset has 2 items. One of the items is the initial cost. One of the items is the initial cost. So initial cost we added together. Remember, after adding the import duty and freight charges, how much was that figure? When you added the import duty in the step number 1 plus the freight charges, we got how much in total? Exactly 900. So that is what we shall be depreciating. It is 900,000. Subtract the salvage value. You are given the salvage value for the new machine. Are you able to see the last at the end of 5 years? The new machine will be sold for how much? 250,000. Yeah, so you minus 250,000, divide by 5 years, because this one is annuity. Divide by 5. So each year for 5 years, how much will be the depreciation? How much will be the depreciation? Yeah, so it is each year, year 1, year 2, year 3, also year 4 and year 5. So it is on the straight line basis. So each year, the reason why I've separated is because of the overall. Otherwise, I should just have them from year 1 up to year 5 years. Yeah, so that is now for that item. Then there is also the one for the overhaul. Overhaul cost. We also depreciate the overhaul cost, but we depreciate the initial cost. How much was the initial cost for the overhaul cost? Overhaul cost ilikuwa ngapi kwa swali? 100. Yeah, but it was incurred at the end of which year? Year 3. So how many years are remaining? Yeah, so we depreciate it over the remaining economic life. It is 100,000 divided by 2 years because it had been incurred at the end of year 3. So how many years are remaining? 2 years. But we use the initial cost the way it is, not the discounted one, when we are depreciating. So how much is it? So it is not there in year 1 and year 3. It is only there in year 4 and year 5. That's why we put it there. 750,000. Yeah. So we now get the total depreciation. So this one will be 130. This one will be 180. That's now the depreciation on the new asset. We have separated them because of overhaul. We have separated them because of the overhaul cost. So that's now for the new asset. We also can replace the one for the old asset. The one for the old asset. So all the assets, we are using the net book value after 2 years. We are using the net book value after 2 years. You remember we calculated? Was it 300,000? Remember how we got the 300,000? But now critical analysis gave us the salvage value. Critical analysis gave you the salvage value. How much is the salvage value after the critical analysis? They say that it is usable for the next 5 years with a resale value of 100. So subtract 100. Subtract 100. But you divide by how many years? 5 years. Because it is usable for another 5 years. So we depreciate it over the remaining economic life. So how much will be that figure? Exactly 40,000. Yeah, so we are subtracting. So it is each year from year 1 up to year 5. So even here, it is 40,000. So when you subtract, we now get incremental depreciation. We now get the incremental depreciation per annum, which means year 1 up to year 3, it is how much? 90. But year 4 to year 5, 140. So that is now our step number 2. we need to go to step number 3, but we have another class at 2 today. Yeah, so when we meet at 2, we shall now go to step number 3. So we can stop there because it is already break time. So that when we meet, we shall continue with the question. So we can stop there for now.